Saddled with ever-ballooning grocery bills, Julie Simpson decided to take matters in her own hands. She started to dilute. This is a recent article in the Wall Street Journal. Simpson, a software marketer in Mississippi, decided to add water to her Dawn dish soap and to her Clorox floor cleaner, diluting them both. She stopped buying aerosol gas cleaner and replaced it with a bottle of Windex so that she could add water to that too. She even thought about diluting her treasured Sensodyne toothpaste, but drew the line there. She squeezes out every last bit instead. And the key line here is Americans are increasingly experimenting with frugality. Well, welcome to my world and Gary's world, folks. This is the Shoe In Show. And this week, our guest is Gary Rains, who's the chief economist for FDRA. Gary, welcome back to the show.
Hey, thank you. Good to be back here, Andy.
Are you squeezing your Sensodyne toothpaste all the way to the end is the question.
That's right, man. Every last bit on that tube I can squeeze.
That's right. It seems like Julie's just joining our crew. As most know, if you listen to Shoe In Show, Gary and I are the frugalists of the group who already probably do this stuff and drive our spouses crazy doing it. But when it comes to shoes, Gary, I think what's interesting is obviously you can't dilute the shoe. Although on the brand side, with increased tariffs, we have seen people stripping out quality or materials. On the consumer side, though, now as we start to see these prices tick up, I think there's two ways to kind of look at it as a consumer. One, you make sure you use the shoe as long as possible.
Absolutely.
So you squeeze it that way. And then the other side is when you're going to the shoe store, you're buying a pair, maybe more when you need it than when you want it, and maybe one pair instead of two. Is that kind of tracking with data that you're seeing?
I think so. With the government shutdown, you really hit the nail on the head that we've had to get creative with alternate data sources to try to get proxies of the data that we've taken for granted for so long on sales and prices and consumer demand and consumer sentiment and those types of measures. And just to cut to the chase, the wife just bypasses frugality and just calls me a tightwad. That's at the end of the day, it's all it is. I'm just the wall.
Miser caucus. So I want to start with kind of consumer behavior and spending right now, and then I do want to get into that data, into where we're at, what data we can trust to this day and age. I think it's an important time to have this conversation. One, because we're heading into or in the middle of the holiday season. Our sales report kind of indicates that people were buying earlier than ever because they expected prices to be higher as it edged into December. So they're trying to find the deals now. And then secondary to that, not just from a consumer standpoint, but from a company standpoint, many companies are planning for 26 at this point, right? They're in budget cycles. They're looking ahead. So we there's this balance is happening, and it depends on the day and the reporter and the news organization. But on one hand, you've got folks saying consumer debt's never been worse. We have some a record number of repos happening with certain cars. People's credit card debts are maxed out. Student loans have kicked back in, and people are making choices about what bills to pay. The other side, articles coming out, Gary, say the consumer is still very resilient and they're still spending. Sure. So where's the truth in that story between those?
Yeah, I agree. You see this dichotomy, not in the news reports, but even in looking at the data here, that points both directions. The consumer doing great on the one hand, and then overextended on the other hand. And I think really it's both. I think if you kind of peel back the onion, look within at different layers within the consumer, that's where the issue is going on. That typically wealthier households are generally doing better and holding up okay, and it is lower income households that are, I think, really feeling more of the pinch and, like you said, squeezing the Sensodyne for all it's worth.
So it's kind of a two-track economy, is what you're saying. Like we've got
it really is. We talked about this.
Yeah, I guess we don't know if it's 10% or top 10%, 20%. It's definitely the 1%, but like below, in terms of the socioeconomic status, below 20% is really the people that are squeezing the toothpaste, is what you're saying.
Yes. In fact, on our weekly Tuesday calls last week, we talked about this concept that economists get all excited about called a Gini coefficient. And it's basically looking at a ratio of inequality within different countries. And the more unequal the wealthier getting wealthier and everyone else getting poorer, the more that Gini coefficient gets out of kilter, and it's believed it's about as widely out of kilter now as it's ever been in the U.S.
And I guess the challenge too is like the old models we use don't. This just seems like a very weird time to try to look at things, because while you're saying that, I also look and see there's low unemployment, wage growth's been okay, inflation has been tepid the last several months. It's not, really had a huge jump yet. So we're seeing like kind of it's the environment's okay, but the consumer is, again, to your point, like in different levels experiencing the economy in different ways, I guess.
Yeah, I see maybe two issues going on here. The first, like you said, is this dichotomy between different slices of the U.S. Maybe some doing okay, wages going up, others wages not going up. Some seeing confidence doing well, even rising. Another segment of the population, confidence not doing well. The second issue is that there have been increasing reports, and not just here the last couple of weeks, but even dating back the last couple of months. Particularly with data from the Bureau of Labor Statistics about how they are having to impute some of their findings, essentially educated guesses as what they think is going on with the data, as opposed to looking at the data and relying on just the numbers that they're getting back in. Yeah. One interesting data point is looking at healthcare costs. That according to the CPI, the healthcare component of the Consumer Price Index, healthcare costs have been going down for 5 years. I dare you to find someone that can show me that their healthcare costs have been going down for the last 5 years. But that's what the CPI basket for healthcare shows. So you've got these two issues at play. Within the economy or within certain market, maybe the haves doing well and the have-nots doing relatively poor. But then even stepping back more broadly than that, the government having to make some educated guesses at what's really going on in the economy, whether it's at sales or wages or prices, and that really just muddies the water for a poor economist like myself here.
Well, let me ask you a question about that. So you're saying that so I know like sometimes with data we have to make educated guesses to fill in some gaps. What's acceptable? What have they done in the past where it's like maybe they get 60 or 70% of the data and then they fill in the rest? But where are we at today with that? Where, like, how much do they actually trust, and then where are they filling in on the top of that?
Yeah, for a number of years, the Bureau of Labor Statistics, and I don't want to pick just on them. It's not just them, but we see this across other government organizations that produce economic data that we really live by. But the Bureau of Labor Statistics typically has imputed about 10% of their numbers using putting together the Consumer Price Index. Here recently, that number has jumped to something like 40%, and it gives me a real pause there. And that has a lot to do with response rates declining over time. That the response rates just aren't what they were 10, 15, 20 years ago, and even beyond that, the BLS themselves has seen their budget constrained the last couple of years, so they haven't been able to put more money after getting higher response rates or increased participation from consumers and businesses alike. So they're really between a rock and a hard place.
So it's kind of, I would say we're not flying totally blind, but it's getting a little bit darker out there, right? And so,
yeah.
And we've talked about this, but it starts to lead into where some of the FDRA's data reports that we have become ever more important to kind of fill in and kind of shed some light on some areas. Maybe you can share a little bit about that in terms of what kind of things we collect, sure. and then where we are with the data. Like, how does the data look for brick and mortar and for e-com?
Yeah, happy to. FDRA collects not only public data available through government sources, but our own proprietary data directly from the industry, really straight from the horse's mouth. And we've done this for decades through our weekly retail sales survey. We've expanded that the last couple of years to do a deeper dive on the e-commerce side with e-commerce sales, looking not only at dollar sales, volume sales, and implied average price on those product being moved, and even looking at returns, both the dollar value returns, the number of pairs returns, and an implied average price per pair on those returns. Beyond the e-commerce survey, we've also expanded into the quarterly sentiment survey that we do, a business executive sentiment survey that goes out to hundreds of different executives across the industry to really get their feeling. And there's no, I think, no better proxy for that than someone that really has their finger on the pulse of the market, that's knee deep in the market every day themselves. And we're able to collect those results back, and you kind of combine them together and aggregate them and anonymously share them back. So it's a way for everyone in the industry between these different surveys to really see how everyone is doing without really seeing how anyone is doing in particular. And it's great in that way that it's completely confidential. And I would certainly ask folks to consider joining these different surveys that FDRA puts together. And a more robust rate of participation gets you closer to the truth, closer to the final number, and arguably I'd say even closer than the government number.
Where are the trend lines then? Like not exact numbers, but what you're seeing in the survey since you put them together, like from brick and mortar and e-com, like where are we at?
Yeah, in fact, we got our latest data through this week. Looking through the first 38 weeks of the retail year, brick and mortar and e-commerce sales are both lower. I think brick and mortar was off some 5%. E-commerce, I think, was off 7.1%. And between the two combined, I think it was off some 5.7% versus the same first 38 weeks of 2004 retail year.
Yeah. So I guess that goes to channel too, because obviously, like, we have a lot of brick and mortar and pure play, footwear folks, footwear brands are part of the survey, where we may not be capturing the same with like mass store market kind of situation, where if you're squeezing toothpaste, we keep going back to this. This reminds me of like Joe the plumber during like, what was it, like the 2008 election or something, but like, so if you're squeezing toothpaste, you're naturally going to go where you can get the most value for something,
Absolutely.
And I think that's probably where I would say, in terms of sales, we're probably flat, if we're honest. I mean, if you're up, it's a certain category, but I think we're kind of flat as an industry, if we're honest, between the data that we see and the government data that we're getting. To your point, still kind of plussing up or filling in a little bit more gap than usual. Is that how you see it? Do you think we're just kind of flatlining a little bit this year because of tariffs and the consumer? And
yeah, really, we have three different measures to get at retail shoe sales. There's FDRA's weekly survey we mentioned, a report from the Census Bureau that lists shoe store sales, and then a broader report from the Bureau of Economic Analysis that measures total footwear consumption. And there's a lot of footwear consumption that doesn't happen in shoe stores, picking on big box or mass or discount that are not shoe stores that are still selling a lot of shoes. So all three of these metrics tend to move more or less in step with one another over time, but there are some gaps between them. And I think there's a lot of insight to be gained by looking at those gaps between them. When we see one tending to do better than the other for an extended period of time, suggests that maybe we're seeing mass account for a larger slice of the pie, or maybe we're seeing that's the pendulum is swinging back to the shoe store side. Okay. Looking specifically at FDRA's e-commerce survey, that also gives us this implied average price for footwear being sold every week. And that's unlike the government data that comes out monthly and has a lag to it of about 6 or 7 weeks. Well, we've got this with a lag of like 3 days. So we really have our finger on the pulse of the market in near real time. I remember talking several weeks ago with Matt, where we were seeing on the e-commerce side that those retail footwear prices were increasing rapidly. And I said, here it comes. We're going to see this show up in the BLS data a month from now. And sure enough, in the BLS data the following month, we began to see those footwear prices tick higher. But we had known this for 4 weeks before it ever showed up in the government data. And I think that's again, more strength in numbers that we can bring to the industry with increased participation to get that better feel for what's going on for the broader industry.
Yeah, I know Matt in particular has been trying to, as best as possible, because it is a private confidential survey. We can't list who is participating. We can't list directly like in-depth numbers, but like even on the e-commerce, we can see the traffic. We can see how long people stay on there. We can see what the conversion rates are, the return rates are, like a ton of data sets on that side, for example. But Matt's committed to try to provide trend lines in this kind of point where we don't have government data coming in to tell us how the economy is doing. So he's providing that in his newsletter called What I'm Hearing, which is the executive newsletter that goes out every Monday morning to executive members of ours. And then also on the Tuesday call at 2 p.m. I know you guys have been sharing extra data sets just to help people kind of navigate this. So there's two ways if you're looking for information. Read Matt's executive brief every single Monday, and then every Tuesday at 2 p.m. make sure you join the FDRA member call that provides economic updates just like this in real time. And of course, both of those are for members. So it behooves you, if you're not a member, to please think about joining and getting access to these critical data insights key to your business. Gary, let me ask you about, like, from a consumer standpoint. So let's say I'm running a retail shop or a brand, and I'm thinking about discounting and pricing over the holidays and in the next year, and I'm thinking about how much inventory I need to bring in and what the turn's going to be. What are warning signs that you're watching from the consumer side that tells me maybe they're going to keep sliding and buying less or are buying down? So is it like, do you look at savings rates? Do you look at credit card delinquencies? What tells us that consumers are going to continue on this path?
Yeah, great question. In short, yes, yes, and yes. We look at a range of different data that everything from savings rates to consumer delinquencies to repossessions to foreclosures to all kinds of positive indicators as well. Even within consumer sentiment or consumer confidence, there's different breaks within that. Maybe you're looking at current conditions or maybe anticipated future sentiment. So there's all kinds of ways to peel that onion back to the deeper levels. And yes, we look at a lot of that, and just painful to tell. A lot of that, like you said, gets sifted down for the Tuesday calls or for inclusion in Matt's What I'm Hearing email. That I'll look at hundreds of graphs in the course of a day and sift it down to just the one or two that I think really drive home what's going on for the industry. And we're able to do that for the industry.
What's the one or two right now that you're really looking at? What do you like? What's the signal from all the noise out there that is it CPI? Is it like, what's the
big ones that I'm watching now with the government shutdown extending 27, 28 days, on into 4 weeks now, and they're saying it's liable to go upwards of 44 days, heaven forbid. If that's the case with no government data, I'm watching closely sentiment numbers and consumer confidence numbers. The consumer confidence numbers come from the Conference Board. Sentiment numbers come from the University of Michigan. So they tend to move in step with one another, slightly, different variations between the two. But there is a pretty strong correlation that we've shown often on the Tuesday call between consumer sentiment and consumer purchases. Typically, it just makes good sense that if a consumer feels better, they're more likely to open the purse strings, and if they're a bit more hesitant and pensive, they're less likely to spend. So, in the absence of spending data now, we can look at that sentiment data and gauge that. Well, I bet you sentiment in this last month did this. Spending in the last month did this because sentiment did that, and it's a pretty good proxy over the short term.
Is that going to be more important to your kind of economic analysis diet, considering that the U.S. government is having to play around with the numbers a little bit more? I don't know a politer way to put that, but like having to forecast up to get to where they think it is versus in the past where maybe it was 10% trying to forecast up. Now it's much higher. Like, so is the consumer sentiment surveys out there ever more important to your opinion?
I think so. In the absence of the government data, we've had to get really creative and dig deeper for other proxies that kind of fit the bill for measures for consumer spending, measures for the inflation rate, measures for different metrics we're trying to get at. And in fact, we had talked about a couple of those just on this Tuesday's call, which is being loaded to the Intel Center as we speak. And encourage folks to have a look there for a deeper discussion of some of these kind of alternative measures that we've have used in place of the government data.
How is the Fed lowering interest rate going to impact consumers in the near term? Will it impact consumers in the near term?
Yeah, great question. So the Fed has cut rates once already, just here about a month ago, and it's really for the first time this year. They're all but certain to cut rates again here at their meeting that concludes tomorrow, and they're again just about certain to cut rates again in December. So it'll be pretty much three back-to-back rate cuts right here into year end, possibly a fourth into early into 2026. There is that knee-jerk reaction of people watching the news saying, "Oh, look, the government cut interest rates, so it must be good for the economy." And that the knee-jerk reaction, they feel better about things just by looking at it's what's happened. They aren't feeling it yet, but they're seeing what the government did and think, "Oh, things are looking better. Rates are coming down." But certainly, the longer term, once the rate cuts begin to permeate the broader economy, typically those lower rates, assuming it doesn't stimulate inflation, yes, certainly that is a big contributing factor in boosting borrowing and boosting lending and boosting increased consumption by consumers and businesses alike.
Yeah, I should note as this podcast comes out, the Fed Reserve will be like late October, so I think this comes out early November, just to make sure by the time you hear it, we'll already have the decision on that.
Yeah.
But are you, in terms of like the Fed and what's happening, I think what the curious thing always is what you just said is true. It's economic behavior of the consumer. But if you're cutting interest rates, it means you want people to spend more money because things are a little tight, right? So
Sure.
it doesn't mean the economy is doing great. It doesn't mean it's doing bad. It just means that there's some imbalance somewhere, correct?
Yes, that the Fed thinks that there's room to cut interest rates in order to be more accommodative, to be more stimulative for the economy without goosing inflation at the same time. Then they'll cut rates.
Let me ask you as we kind of wrap up where we're at. Well, I guess two things. Holiday sales, from our consumer survey, it seemed like they were holding up pretty well. But as we enter like 26, are you more cautious? Or are we still looking at a flat line? Or are we looking at, what are we looking at in 26 if all these things hold and savings rates are decreasing, borrowing is going up? Like you always say at some point you gotta pay the piper or whatever it is. So
Yep.
what?
Eventually, someone's got to pay the piper.
But at the same time, employment's still low. People are still employed. Wages are okay. So there's still available credit in the market to use. So how do we balance that when we look at 26 for planning?
Yeah, certainly. Despite some of the doom and gloom I talked about earlier, these issues of repossessions and foreclosures and increased charge-offs and delinquencies, that sort of thing, the consumer on the whole is doing well, and the broader economy on the whole is doing great. That the economy is set to expand in 2025 more than anyone thought. Certainly more than I would have thought 9-10 months ago. And early indications suggest the economy is going to maybe slow down a bit in 2026, but it's still set to grow again. If that's the case on into 2026, this will set the record for the longest expansion of the economic activity we've had in the post-war period. Really, it beat the previous one from just about 10 years ago, and this one already is going on 10 years long. So right now, there's nothing on the horizon that could, kind of borrowing from the old economist expression, that could kill the economy. There's nothing out there. There's no murderer that this other economist some years ago had quipped about. There's no killer out there that would kill the economy. And economies don't just die of old age; they get killed usually by a mess up in monetary policy. And right now, I don't think monetary policy is set to be messed up. It's turning more accommodative, and I think those lower rates, assuming again it doesn't stimulate inflation, will be good for consumer spending and business borrowing and longer term economic vitality.
Yeah, and obviously the stock market keeps creeping up. And perhaps part of that I think is kind of figuring out the trade truths and truces between governments of where they're at, and trying to find a landing to where rates will actually be for businesses to better plan and know. I guess one concern, kind of where we're at too, is the marketplace bubble. We can use AI. I'll just use tech generally because I think AI is so misunderstood, to be honest. I've talked to a lot of folks and they don't seem to grasp what it is and in some ways, yes, it's very transformative. In other ways, it's just another technology and tool that we have. Until I see a robot show up at my door, that'll be a different story. But there's a lot of just talk around where government's investing in technology like they haven't in the past. Like we've got, billions of dollars flowing into chip semiconductor manufacturing, and then we've got like AI companies moving money around between themselves, and it's creating this like kind of conversation: is this money real, or is it just flowing around? And they're shifting it on their balance sheet, and that could that not kill the economy though? Like a bubble burst where the confidence erodes. I mean, part of what I think about sometimes is like maybe I need to like pull my money to the sidelines in the market, and then the second part of me reminds myself and slaps myself that you can't time the market, right? So.
Yeah, I'm not much of a believer in timing the market, but to your question, could it kill the economy? It certainly could dramatically slow things down. Whether you pick on, the Y2K internet-led bubble, of course, equity markets were doing very well. That was a contributing factor. The retrenchment in equity markets was a contributing factor behind the broader economy, downshifting in 2000, 2001. Same thing with the global financial crisis, late '07 into 2008, 2009. Of course, we saw equity markets also had retrenched rapidly there as well. Now, whether you're more a believer of the tail wagging the dog or the dog wagging the tail, the two issues certainly coincided. So I don't know that I would necessarily say that it would kill the economy, but it could be I think a very key factor behind that reverse wealth effect that we've often talked about. Wealth effect being that people are either making more money or earning more money, just feel wealthier. Equity markets are well. Housing is pretty close to its peak from a couple months ago. People have a lot of equity. They feel pretty good about their situation, and they're more likely to spend. On the other hand, with that reverse wealth effect, if those equity markets take a nosedive, people are not going to feel quite as upbeat and optimistic about spending, and might cut back and pull the purse strings a little tighter.
Yeah, it is time to take out HELOCs, folks, so you can buy your footwear. That's the best way to do it. I don't know about I'm kidding. Obviously, that's not good advice at all. But some people obviously do that to buy certain things. I think the other thing too is like sometimes we, from a behavior perspective or from a confidence perspective, when we see negative headlines, we're always waiting for the other shoe to drop, and it's like these bubble conversations that we have they're legitimate. I mean, we should be aware, and fear is not a bad thing when we're thinking about the economy sometimes. But the earnings reported by public companies and private growth is quite robust. Like it's been churning along. I mean, there's a reason for market optimism overall and kind of consumer optimism. And again, to your point, housing is up, like equities are up, and the amount of equity that we have in our homes is up. Like, so there, there is a balance, but I do think there has to be a balance too in our fear of what's happening, because if we keep sticking with this like notion, there's always a bubble, and there's always going to be a bubble somewhere. But like, I think it's just, I think maybe I'm convincing myself sometimes to be a little too afraid. Whereas if you look at like revenue growth and spending, it's still quite good.
Yeah, talking about the equity markets doing so well, I caution that while equities are doing well, real estate is near its high. At the same time, you're seeing, alternative measures that are also at or near record highs. You can pick on gold or silver or even Bitcoin. That these issues are maybe used as hedges against issues going on in the broader economy, hedges against inflation. So it's not that everything is all rosy. So they always talk about the two-handed economist. This is another case that just because all these different indicators are pie in the sky, or all these indicators are up, doesn't mean that everything is pie in the sky. Picking on gold and silver, for example, that those are give me a good bit of pause, really, that everybody is not so upbeat on prospects for the economy if we're seeing that gold is just off its all-time.
Well, I saw the other week, like the equities markets hit like almost record highs at the same time gold was hitting record highs. And I couldn't figure it out because your point, gold is the hedge, right? So like if things are so risky, that's where you flock to. And it seemed like then there was a both. It was like if you had a buck, you were splitting it both ways or something. Like
Exactly.
I don't know. I couldn't figure it out. I was so confused. What's happening? So
And usually, the dollar itself is used globally as a hedge for flight to safety. When people get a little wiggy about how things are going on globally, you see everyone flock to the dollar, and that tends to strengthen the dollar. And the dollar is not as strong right now as it's been over the last couple of years. In fact, it's weaker year over year, and you're near its lowest in the last, I think, the last year and a half or so. So not everyone is flocking to the U.S. or necessarily flocking to the dollar. So there's some of that underlying hesitation there.
Yeah. So let's wrap this up. If we're a shoe company and it's Rains Polk Footwear, it's raining Polks. Interesting. Rains Polk Footwear, and we're having a board meeting and we're looking at this economic data that you look at, and we're looking at sentiment and looking at markets. Is it just a good policy in 26 just to say, let's steady the ship and keep where we're at? Like, let's not pull in more product. Let's not be overly bullish. Let's like stick to where we think we can. Like, let's double down on trying to find cost savings. And is that our board meeting? Is that the conversation we have as we plan in 26?
Yeah, with what I see right now in very broad brushstrokes, not a whole lot different than 2025. We had said months ago that footwear spending was set to be modestly higher, maybe 2-3%. And some companies are saying 2-3%, our company did great, and others are saying 2-3%, our company didn't come anywhere close to that. We were underwater.
Yeah,
granted, but on the aggregate, the industry as a whole up, spending up 2-3%. And I think right now, looking ahead to 2026, with what we have with a very cloudy crystal ball from the government, right now it's looking similarly modest growth at best in 2026 for footwear spending. Again, another 2-3%. There's of course a million different variables that go into determining whether that ends up being a much stronger number or even turning weaker. Maybe the biggest among those is broader trends in the U.S. economy. Is GDP going to expand, or are we going to see a recession? I don't think we're set to see a recession. I think growth will continue in 2026, just slower than what we are liable to finish with this year. And by extension, that sinking tide tending to lower all ships again. That if we see slower growth in the economy, I think it's liable to spill over to slower growth in footwear spending.
Essentially, I just thought of the way that we can phrase it for 26 and wrap up our board meeting we just had. It's called a grumpy growth. So while we're growing, we're just not that happy about it. It's like it's a hard growth, right? It's sure. It's grinding growth in some ways. So grumpy grinding growth in 26.
I think that's a fair assessment. I'll take it.
And we'll wrap with that, folks. shoeandshow.com is the website with our entire catalog of all our shows. This is a kind of an insight to. Actually, this would be a normal call if I called Gary and we had a conversation about what was happening, try to figure out how to position things and talk to people about the economy. So that we just let you into our board meeting. Rains Polk Footwear. If you want to buy us out, we are for sale. So just let us know that too. But Gary, thank you very much for coming on and kind of breaking down some of these things in this kind of murky, uncertain era that we have.
Absolutely. Always happy to help.
Folks, thanks for listening. Next Monday, new episode drops. If you have questions about what we talked about today or need access to data sets, etc., if you're an FDRA member, drop us a line on info@fdra.org, and we'll make sure you have access to those to help you kind of look at your own internal data and compare that with the data that we have as well, so you can make more accurate, faster, stronger decisions for your business and especially for margins right now. If we look at increasing costs, flat line of sales, and a consumer who still wants a discount at the holiday. Hooray! Grumpy growth, folks. Until next time, Shoein is out.
Shoein has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.